Part 3, Revenue Recognition. We're going to look at discount, standalone pricing, and incentive payments. Now, our first example, assume Mike Studios offers a deal whereas by enrolling in a new membership for $700 provides a year of unlimited access to the facility and entitles the member to receive a voucher redeemable for 25% off yoga classes for 1 year. The yoga classes are offered to the gym members as well as to the general public. A new membership normally sells for $720, and a 1-year enrollment in yoga classes sells for an additional $500. Mike Studio estimates that approximately 40% of the vouchers will be redeemed. In addition, Mike offers a 10% discount on all 1-year enrollments in classes as part of a normal promotional strategy. How will the revenue be recognized? Now let's apply the 5-step process. What's the contract? Well, what we're going to do is provide gym services and a discount on yoga classes. Performance obligations, there's 2, gym membership and a discount on classes. Transaction price, the amount of the consideration is $700. Allocate the transaction price to the performance obligations based on fair market value. Okay, the performance obligation we met over the year of the gym membership and when the yoga membership is purchased using the coupon. So the company will recognize revenue over 12 months for the gym and when the yoga coupon is used. So what information do we need? We need the $700, the 25% discount, the $700, the normal price of the gym, $500, the normal price of the yoga class, the 40% discount, but also we must consider the 10% that's normally offered regardless. Okay, so this is relevant because since it is offered for every service, it reduces the 25% discount for yoga to 15%. Now what we're going to do is figure out our fair market value or standalone pricing. So we have 1-year gym and yoga, we've got a coupon that normally costs $500, and what we're going to get is we're going to get 25% minus 10, which is the normal discount, so this is worth $75. We estimate 40% will redeem, so the standalone pricing on the discount is $30, giving you a total standalone price of $750. Now we have to allocate the $700, and we end up with $672 for the gym membership and $28 for the 1-year yoga coupon. So if we sold 10 memberships, it would be cash, $7,000, deferred revenue membership, deferred revenue yoga coupon. Now, just so you know, that deferred revenue membership fees would be allocated over the 12-month period. Now, example 2, standalone pricing. Mike sells a set of golf clubs with a complimentary club fitting. A full set of clubs costs $1,500, and a similar club fitting services are offered by other vendors for $110. Mike generally charges 10% more than other vendors with similar services. Mike sells the set without the fittings for $1,400. It normally costs $60 for the fitting service, and they normally charge 30% over cost. What is the standalone selling price of the fitting? There's different ways we can do this. We can use the adjusted market assessment, the expected cost plus margin, and the residual approach. Now, what if the performance obligations are not sold separately? There are 3 methods to estimate standalone pricing. We have the adjusted market. We estimate what it would sell for in the open market based on other companies that provide the same service. We estimate the cost and then add a profit margin, or residual pro subtract the knowing selling price of the performance obligation from the total, allocate the rest to the other obligation. So we'll work through all three of these. If you cannot allocate the price to the separate performance obligation, then you must allocate over the longest period. All right, so here we go. Here are our facts. What if we used adjusted market assessment? Well, use the price of the other vendors plus 10% markup equals $121 would be the standalone price for the club fitting. We would subtract that from the $1,500, so at the time of the sale for the golf clubs, $121 would be assigned to the fitting, and $1,379 would be assigned to the golf clubs. Now, same problem, and we're going to use the expected cost plus margin. We're going to take the $60 plus 30% times $60 tells us our standalone price for fitting is $78. We're going to subtract that from the $1,500, which means $1,422 will be going to the golf clubs and $78 for the fittings. Now we're going to do our last method. This is called residual approach. We know the selling price is $1,500. We know that by themselves they sell for $1,400, which means we'll assign $100 for the fitting. So we'll book $1,400 at the time of the sale for the golf clubs and $100 when they get the fitting. Now let's look at another example, looking at variable consideration. Now, my company received a contract for a cost-reducing program to provide services over 6 months. They will receive $20,000 at the end of each month. If they reach a specific target, they will receive a $10,000 bonus. If the total savings falls short, they will have to pay back 10%. Mike estimates there is an 80% chance of getting the bonus. Now we'll go through our 5-step process. Identify the contract. Is to provide consulting service for 6 months with variable consideration. Identify the performance obligations. We only have one, but it is with variable consideration because we have an incentive or penalty payment. Determine the transaction price. The amount of consideration transferred to the service is $60,000 plus or minus $10,000 for the bonus. Allocate the transaction price to the performance obligation based on fair market value. Well, we have the fair market value, but we have to do it 8 months adjusted for the bonus or lack thereof. So, what we're going to do is we're going to book the consulting services adjusted for the bonus. So now we're going to take a look at how that's done. My company, here's our rules. So first thing we're going to do is getting the bonus. We're going to get $20,000 times 6 months plus $10,000, and there's an 80% chance we'll receive that much. Not getting the bonus, there's a 20% chance we won't get the bonus. So that tells us the expected total value of our contract is $126,000. Journal at the end of each month. It's going to be the $126,000 divided by 6 months. Bonus receivable will be $1,000 and cash will be $20. Now we would end up doing that journal every month until the end. The end of 6 months, cash will be $10. We would reduce our bonus receivable and book our service revenue of $4,000. So in this example, we're taking our bonus receivable off the books. We book the difference that we didn't accrue, and that's how we do that entry. Now, what happens if we don't receive it? Well, we have to take $16,000 off the books because we have to take the $6,000 that we accrued plus the 10,000 we have to give them back, which would be that 10,000 right there. And that concludes part 3.